Hello everyone for another weekly meeting Q&A section. So if you end up joining live here, you can ask me anything. But I do have some kind of pre-recorded questions that have already been sent to me, and so we'll kind of knock out some of those. We're going to talk about some drawdowns today. We're going to talk about making money with those. We're going to talk about just in general where the market is. We're going to talk about the reverse repo market, which let me pull that up because we're going to kind of refer to that in just a second. We talked about this last week. So has been a little bit of changes on that regard. Let me pull that up. Perfect. And so we're going to kind of go down all that path. As always, of course, if you are here, let me just kind of throw this up. You can basically ask us anything in the chats, and we will discuss it live here on the show. All right, if you're watching a recording of this, of course, you can skip forward and go to all sorts of things. But first, we are going to go through the market recap. And as always, like I said, throw something in the chat. All right, so as far as where the market is right now, we have had a rally that should not be too surprising. I know my members over at Adapt Advanced, we talk about this on a weekly basis, that we've basically been kind of in this little downtrend, but we weren't thinking that the downtrend was necessarily going to hold. It was kind of a toss up between either we kind of trend down a little bit more or we pop up. And we started to get some signals that we were going to pop up a few days ago. So that is what it is. And we've come up into our upper volume range. If you guys aren't familiar with this, we talk about volume ranges in Adapt Advanced. And as we pulled up into this, we've got some targets here to the upside. So it's definitely not surprising to see us push up here. It's honestly not even too surprising to see us get all the way up to these upper targets at 46, 42. But, you know, in general, things are starting to slow down. The recession is going to start to kick in here any month now. I've been looking at probably planning it around late September to early October is probably when everything will kind of kick in. But it's kind of a more typical pattern for us is to kind of have the volatility kick in late September or October. One of those old sayings, I think it's sell in May, go away, October is buy another day or something like that. Anyways, it's an old saying, a Wall Street saying anyways, so we'll see where things go. And as far as where we're looking to likely go in the future, like I said, pushing back up here and rolling over wouldn't be anything unheard of. In fact, this blue line that I've got in here would actually be something that would be really reasonable to kind of chop up in this volume range and then roll over into the recession, coming into October. So that's where we are as far as the market is concerned. We can jump over to some of the other indices and just kind of give us a general overview. I don't have all the technicals and stuff that I normally have on any of these. There we go. But you can see here, we've had this really aggressive trend up to the upside as we've had new money kind of flush into the system, especially right around here where the reverse repo started to get drained. And definitely as the GDP started to accelerate, we've had this. Now that GDP is starting to decelerate, or as it's about to, we're going to start to get some of these more rollovers and some kind of choppy areas is very likely. And that volatility will probably persist a little bit until it rolls over. It's going to be hard pressed for the NASDAQ to retouch its lows. I doubt that it's going to get back down there, but definitely get back down into these range of 12,600 or so would be reasonable. All right, and then let's see the Dow. The Dow has actually struggled just a little bit, but that's kind of our safe haven thing. It's not as sensitive to growth. It's more sensitive to like a risk off behavior. But anyways, it has been pretty stable, steady Eddie over there. As far as small caps will give us some of our biggest inclinations of what is going on as far as risk. And we can pretty much see here that it's basically just been chopping around. Even with the reverse repo draining, we couldn't push up into an uptrend really. So we're kind of stuck in this general trend. And I doubt that it's really going to start doing anything more. So if you're a technical trader, you've probably been having a fantastic time in the Russell as you've been pushing into these highs right here because they've been great selling opportunities and great buying opportunities down here as long as this pattern persists. Now that it's such an obvious pattern, it's likely that it won't hold up. So we're either going to push up into a little bit of highs before we roll over, or we're just going to roll over and punch through the bottom here as we go into the recession in October through roughly July of next year, right? So that wouldn't be unheard of for the Russell to probably get down maybe 1560. Is that pre-COVID? That's probably probably COVID area, pre-COVID area would probably be pretty reasonable for this guy. I doubt that it'd ever get down this low. That would take a really nasty recession. It's possible, but really, if we just project out, let's just project out basically where we came down originally, and we'll just grab this and kind of throw it down here. That's kind of a reasonable push down. Two consecutive quarters of back-to-back contracting GDP with a risk off. That's likely what you'll see again. So, 1368, nothing unreasonable, but that's probably where it's likely to go. All right, let's talk about the reverse repo market, since we're kind of talking about macroeconomics in general. So if we share this, we can kind of zoom down here and we can see what has been going on in reverse repo land. Now, I talked about this last week, and I'm just going to touch base on it one more time because I do get asked about this quite often. So the reverse repo market is kind of a interesting animal. It's basically like it's just a parking spot for money and treasuries per se, actually. So when money is being pulled out of the financial system because there's too much money in the system, it goes into the reverse repo market. And so that's what was happening during 2021. Basically, there was too much printing. Boom, it gets pushed into this. It's like a big giant piggy bank that's building up. And then eventually it stalls out as the printing stops, right? As soon as the printing started to stop completely, then all of a sudden there's no need to push into the reverse repo market. Also, the reverse repo market is being changed as far as its yield. So every time the Fed raises interest rates, they move this up just a little bit above so that there's a little bit of extra yield coming out of the reverse repo market than what's happening in the open market for short-term interest rates. So it's kind of working as a ceiling. So if the bond market starts to go crazy, basically this money comes out and starts to flood the market, and it stabilizes the bond market, right? So now that we started to get into about May of this year, so if we look back here in the market, you can see here in May, we started to get this kind of balloon up. And this was also shortly after I think the banks kind of blew up. I think the banks started to have problems. And I think it was I want to say it was April or May. Anyways, and that ended up kicking us up because there was some money being flooded out. And then if we go to the S&P, it's even more clear, where everything was kind of chopping around. We were kind of hitting our ceilings here, and then all of a sudden you get this like acceleration to the upside, and that's because money was being drained out of the reverse repo market, being put into the bond market. The bond market supplies risk for the rest of the market, so leverage is allowed. So boom, there you go. So anyways, so that's where that goes. All right, now let's talk about where things are at. So I always get questions about the Abe oscillator. So the Abe oscillator is basically a way to measure how strong is a structure of like a theta kind of butterfly or condor structure at the money, or near the money, I should say. So if you're doing, broken wing butterflies, or you're doing butterflies hedged with calls, or you're doing condors or broken wing condors or unbalanced butterflies or blah, 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 blah. Right? If you're trying to pull premium out of near the money, then this is basically the kind of go-to. This is designed for 10 days and beyond. So anything out, 10 DTE or further in DTE, this is what's going to grab that edge. So it is a machine learning algorithm, so it's pulling that all in, and it's worked really well in the past. In fact, back here when we had this recent spike, I got into a lot of at-the-money butterflies. We made a boatload of money really quickly. And then as it pulled down, I definitely got out of those. And then as we pushed back up, I got into more of them. And so that's kind of where we're at right now. So we're looking forward to making some more money again. And this will probably drop down as the market kind of goes crazy again, most likely. And so this is where we're at. We've kind of pulled back from the highs from the green areas, and we're kind of in this middle range. So there's still an edge for certain. There's still an edge in it, but it's not a really strong edge. It's not like a shooting fish in a barrel type of edge. It's there. It's just minimal. When we get down in here in these reds, I basically don't even trade at the money structures for condors or butterflies or vertical based structures like that. That's when it starts to get really dangerous because the edge is so dwindled. All right. So hopefully that kind of answers that question about where that is. Of course, you can still sign up at etradingedge.com if you want to. And let me make sure there's no questions coming in. No, we're good. So you can still sign up for that system. It's like $29.75, I think. It's pretty cheap for a monthly basis, but it does give you very, very accurate information on how much to lean on that edge. What I do is I either increase structures that are around ATM or I decrease structures depending on what my trades are. And then of course I can also increase allocation or decrease allocation based on this as well. So anyways, it's cheap enough that you can kind of jump in and play around with it as you kind of see some things. This is a 90-day window right here, and it is a daily chart down here, so you can kind of see that. I know I don't have labels down here, but just to give you kind of an idea of that. And the other thing that we were going to talk about is drawdowns. So recently I added, recently I added a chart to like the daily adapt and or things like that, and it is down here. And so I just added this little estimated max drawdown potential, and I get lots of questions about these. So when we originally design these strategies and we test them and we're back testing them and then we live trade them and things like that, we have kind of an expectation of where the statistics should stick around, right? And we have what's called a max drawdown potential. And that max drawdown potential can definitely be exceeded, but we definitely know where that line is in the sand based on our data, right? And so for the Adapt Daily, it was just north of 16%. It was like 16.5. We ended up drawing down about 17, I think right at 17 was what we ended up drawing down before we bounced at. So pretty much right on the tack. And this is a really, I think it's a great opportunity to kind of see how I do things. A lot of people ask me, is there something wrong with the strategy? Is there something going on? Why is it losing so much? Those are normally the questions that I get when things are getting really beat up. And what's interesting about that is typically, as long as I'm not seeing anything weird, then what ends up happening is I look at it and I go, well, it's just having one of its rough time periods. And so as long as once we get a little bit closer to this max drawdown potential, you can kind of think about it like a Bollinger Band or a kind of a mean reversion type of way to kind of deal with this. So the closer we get to this max drawdown potential, normally the better it is for what I do, at least, is to increase my exposure to that strategy. So if I had some cash on the sidelines, if I wanted to take out a little bit extra out of one of my portfolios that don't necessarily run as hot as this, I can take it out and just kind of pump it in for a little while until this bounces back up to its typical gains, and then I'll just kind of pull it back out, right? So you can mean revert the strategy as a whole too. So that's kind of a cool thing. I get asked how to deal with that all the time, and so that's how I deal with it. Is I'll typically grab a little bit more exposure, or I'll take it out of a trade that's making really good and is extremely high above its max drawdown, and then I'll put it into something that's more max drawdown. So it's not necessarily a subjective thing, because I do have a systematized process for how I allocate. But sometimes what I'll do is I'll do a force allocation at that point if I allocate on a quarterly basis. So instead of waiting for the full quarter, I'll basically just do a really quick allocation right then, and it'll kind of even things out and it'll push money into it. Anyways, I have that, and it goes on, and you can see we hit our high water back here at 150,000. On 518, we went through our little drawdown, and then pop, we went back up, and I believe we... Oh man, did we exceed it? 150, 524, 150. Oh no, we're just shy of it right now. So we're about to tag our high water mark, and then this will push up again because it follows the high water mark. And you can see that this is the case. So just like keep this in mind, kind of in your head really quick. 518, we went through this big drawdown. I would have liked to rebalance, which I did in 717. And if we go to one of the other strategies like the intraday. So if we go down here to the intraday, which you can see it's had a really rough month, these two trades are really interesting. Oop, I grabbed daily again. If we go down here to the intraday, it's a really interesting thing because like I said, these are kind of opposite of each other. And if you look at the equity curves, it's kind of an interesting thing. So back in 717, 712, this one started to do really amazing, right? Really started to kind of pull up and lift. And you can see that a lot of the times they offset each other, right? Back in 517 of 2023, you can see big rallies through that. And like I said, they counteract each other really well. I did a presentation at Aramir about this, and eventually I'll add that same class onto eTrading Edge so that way people can get it through our site as well. But anyway, so here you can see that we're really close to our max drawdown. We had a gain today, but basically we're likely to start bouncing from here because this is where our max drawdown is. And these are normally where we get these kind of strong bounces too, because it kind of reverts back to the statistical mean and we start to push higher and we start to get, way up here. Now, how it does it is kind of all sorts of different ways. Right back here, this was a really long period of just being kind of chopped around, and then we went through this big strong rally. But you can kind of see they kind of chops and does its thing. So, anyways, I add this to the charts that way we can see that, and you guys kind of can figure out how to use that as far as what is meaningful to you. Also, something nice about having a max drawdown is typically it really helps me mentally to kind of know what amount of money I've locked in on a system. So for instance, all this rally, I'm not anchoring on the fact that, I'm up to, 29,000 on this little trade. I'm anchoring on the fact that at this moment, I know my risk is only getting down to 23,000. And then once we get pushed up into these highs at 40,000, I know I've locked in profit into this because my likely drawdown is only down here to 31,000, right? So that's what helps me a lot is like when we push into these highs, oh yeah, 44, all right, great. That means I've locked in a little bit more because every stair step up is me locking in. And that's kind of like all of this down here is kind of like house money. It's been locked in. It's kind of de-risked, I should say. But all of this up here, up above this line is fair game, right? It can chop around, it can do whatever. But that way I'm not anchoring on any of those high waters. And this is helpful too because when we get up to this high water, like I said, 38,000, you can run this all the way back and you could say, okay, 38,000 is when I lock that in. And as money managers or as traders, humans, we look at an account and we say, okay, I've traded this for X amount of money. Where am I at, right? And in these drawdowns, what can happen is we're at, 39,000 right now. And you sit there and you go, oh man, I've been working on this strategy. And let's just say, bad timing awards or something like that. We got in right on like 421, right? And that means, okay, I've gone, X amount of months, 4 months, and I've literally not made a dime, right? That's what we kind of think, right? That's just the natural psychology of what happens. And you go, oh, well, this is garbage, right? It's not working. It's clearly chopping around. It's doing stupid things, right? Because of course, if you take this drawdown, that's what happens. But at the same time, you're statistically in range, and this is a good time to kind of normally jump in and get bigger or something like that. When these things are way far away from the high water mark, that's not a time to jump in and get bigger and things like that. That's typically when you're at a higher risk statistically to be pulled back. So anyways, I think it's a nice graphical representation, and it goes forward, right? I have talked about, I've been asked, and I'll think about, adding it, but basically some sort of polynomial regression to have an estimated return profile, like it projected out in the future. That's something I might add, and we'll kind of see as far as that goes, because I know some people are requesting that, so that way you can kind of see in general what it would necessarily project out to be. Alrighty then, guys. Well, so very smart idea to add the max drawdown estimation. Helps with the psychology of trading and what to expect. Yeah, I mean, it's a nice, like I said, it's something that I've always had in my head, but it's been nice to just put it visually so that way people can see it. And, that way you can sit there and go, okay, if we grab up our other strategy and you sit there and you go, okay, hey, look, where are we at right now, right? We're getting really close. Boom, that's a great time. Right now, we're starting to get far away, but granted, we're still below the return profile. So we should expect this to keep going up. Now, it's not going to go in a straight line, clearly, but we definitely should start to see this push up now. And we are almost to our high water again, like I said, within $500 or so. So this will actually start to notch up again, and we'll start to do our climb. So this was predominantly one trade that created a lot of issues for us, but I was talking about the fact that during that time period there was aberrant behavior in the market, and that aberrant behavior I knew was coming from the reverse repo market being drained, but because of the limitations of the variables in which the options structures are designed around, to adjust for that on the fly is something that like we can do with an adapt advanced and stuff like that, but it's much harder to do with kind of a set systematized process. So sometimes just dealing with that is kind of what we got to do. I am working on optimizing that to where maybe that's not going to be such an issue going forward. But basically what happens is when you get a bunch of new money coming in, say like quantitative easing or different areas like that, what'll happen is and especially with the huge influx of zero DTE trading and stuff like that, that options are being used a lot more for leverage rather than actually buying the underlyings. And so when you don't buy the underlyings, but yet you're using your leverage, you start to get this inverse volatility relationship, and it starts to create some aberrant options behavior. So that's something that I'm keeping in mind. I'm definitely working on seeing if I can optimize that a little bit better. And so there might actually be some changes to this system to make it to where that trouble, specifically that kind of trouble, doesn't happen again. But either way, it still went down to that max drawdown perfectly, bounced right off of it, and we've had a stellar time. In fact, we've recovered from it faster than it actually took us to draw down. So good risk management. Alrighty then, I am going to wrap it up there for the week, and as always, you can join me every week. I do typically do this at 2 o'clock Pacific, 2 p.m. Pacific. Today I was a little bit late just because I had a couple other meetings that was running into, so there you go. But you can always send out any kind of questions that you have for next week or anything over at info@etradingedge.com, and let me know there. All right, until next week, I'll see you guys.